The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
And we still tell kids to go to school, get a job, work hard, save money, and get out of debt.
People who are poor, it's because they actually don't see reality for what it is. Because the way they see reality, they see making money to be impossible or incredibly difficult, or it's only for a certain select people, not for them.
A financial crisis is not always a disaster for everybody. It's also a golden opportunity. While everyone else is busy panicking, what if you could take steps to build real, lasting wealth during all that mess? Sure, it sounds a bit crazy, but history shows that some of the most successful people found their footing during economic chaos. They used the panic for their benefit and built enormous wealth, which means that it's actually quite possible. So, how do you turn a crisis into an opportunity? Let's dive into the details in today's video.
What is the very best way to make money then in 2023?
That's a good question.
Every economy thrives when there is a movement of money and people are able to produce goods and services with increasing efficiency. But like many times, this ideal scenario gets disrupted and everything starts to fall apart. It's called a financial crisis, and it can impact societies in several ways. The most obvious effect is job loss. Businesses often cut back on staff, halt hiring, or even shut down completely. This leads to higher unemployment rates, which puts stress on individuals and families. People struggle to pay bills, mortgages, and other essential expenses, which creates a ripple effect throughout society. When there is lack of incoming cash, we see a decrease in their savings and investments. For example, stock market crashes or real estate downturns can wipe out a lot of personal wealth in the blink of an eye. If you've ever seen your retirement account lose value overnight, you know how unsettling this can be. On a larger scale, governments may face tough decisions. They might have to bail out failing companies or banks like the 2008 financial crisis, leading to public debt and sometimes higher taxes. While this is meant to stabilize the economy, it doesn't always have immediate benefits for the average person. For businesses, a financial crisis can stunt growth, cause bankruptcies, and halt their expansion plans. Consumer spending shrinks because people are worried about their financial future, and they're less likely to buy non-essential goods. As a result, even businesses that aren't directly affected by the crisis still feel the pinch. So overall, everybody suffers, but there are people who know the art of turning even the worst times into profit-making opportunities. Warren Buffett, who is the 94-year-old American business mogul and philanthropist, is known to be a successful investor of the 20th century. He has built a personal fortune of more than $60 billion by defying prevailing investment trends and keeping an eye for opportunities when no one else seems to find them. He said, "Be fearful when others are greedy, and greedy when others are fearful." Warren Buffett's timeless advice rings especially true during financial crises, as history shows these challenging times are often ripe with opportunity. And Buffett wasn't the first person to make wealth this way. Some of the wealthiest folks in history before him made their fortunes by jumping in when the market looked scary. Let's start with the Great Depression of the 1930s, a time when the economy was tanking, businesses were shutting down, and people were losing jobs. Oil tycoon J. Paul Getty didn't let that stop him. He bought oil stocks at super low prices, knowing they'd bounce back. When they did, he was set for life. So what was the Great Depression like? It began with the 1929 stock market crash and is known as the darkest economic period in history. But the crash itself was just the tipping point. The 1920s had been a period of economic prosperity, with industries booming and stock prices soaring. Many people started borrowing money to invest in stocks, assuming prices would keep going up. This led to something called a bubble, where stock values were way higher than the company's actual worth. When the bubble burst, panic selling took over. Banks had loaned out huge amounts of money to investors who suddenly couldn't pay back their debts. As a result, many banks failed, wiping out people's savings. With banks collapsing, businesses couldn't get the loans they needed, which meant they couldn't pay their employees or buy supplies. This triggered a wave of job losses, and consumer spending dried up. It stretched through the 1930s, leaving millions of Americans without jobs, homes, or savings. American economy shrank by 30%, and the unemployment rate reached 25%. Businesses closed left and right, banks collapsed, and poverty skyrocketed. People were lining up for bread and soup, desperately trying to make it through each day. The U.S. economy had never faced a downturn of this magnitude, and its impact reached across the world. But amid this turmoil, there was a person called J. Paul Getty who saw an opportunity. While most people were selling off stocks and assets, Getty used the chance to buy oil stocks and drilling rights at rock-bottom prices. Oil was in low demand during the Depression, so Getty got assets for a fraction of their original value. He was betting on an economic recovery, and when it finally came, his oil holdings were worth a fortune. Getty's strategy of buying low during a crisis and holding for the long term set him up to become one of the wealthiest men in the world. He said that, "If you can count your money, you don't have $1 billion. Of course we don't, Mr. Getty, but who knows? One day we will. For that, you will have to invest like a pro." Getty also said that, "I buy when other people are selling." This strategy made him the richest American at one point in 1957 and was worth $6 billion when he died in 1976. Not only individuals, but companies like Chrysler also found ways to thrive in tough economic times. During the Great Depression, Chrysler focused on making affordable, efficient cars, which gained immense popularity as Americans needed cost-effective transportation. The brand's most notable success came with the introduction of the Plymouth line, which offered quality and value at a lower price than competitors. In 1933, Chrysler released the Plymouth 6, a car packed with practical features at an affordable price. This model quickly gained popularity among middle-class buyers who needed reliable transportation, but couldn't afford the high costs of other brands. By emphasizing practicality and economy, Chrysler carved out a niche in the market and became the third largest car manufacturer in the United States by the end of the 1930s. Another big name that pops up as an example of using a financial crisis to make wealth is John D. Rockefeller, the founder of Standard Oil. While much of his fortune came from early business acumen and the creation of a monopoly in the oil industry, his success during financial crises can be attributed to his strategic investments, strong control over his industry, and his ability to buy up smaller companies at depressed prices. During the Panic of 1873, which caused a severe recession, many businesses collapsed and banks failed. But Rockefeller, whose Standard Oil had grown rapidly by this point, used the downturn to expand his control of the oil industry. He was able to acquire struggling smaller oil companies that had trouble surviving the financial storm. He knew that the tie may be bad right now, but it will bounce back and oil prices will grow. So he did what he thought best, and by the end of the 1870s, he had effectively gained a near monopoly over the oil refining industry, controlling more than 90% of the market. Rockefeller's ability to thrive during financial crises was also linked to his business practices. He had an incredible capacity to drive down costs, which allowed him to continue profiting even when others were struggling. His company was highly efficient, and he used horizontal integration, which means buying out your competitors to consolidate his power. This not only eliminated competition, but also allowed him to set prices in his favor. In addition to his shrewd business maneuvers, Rockefeller also had diversified investments, which included railroads, steel, and banks, and allowed him to maintain wealth across multiple industries, even when one sector faced trouble. As a result, Rockefeller's fortune continued to grow, particularly during times when other businesses were shrinking. Now let's talk about Warren Buffett, the Oracle of Omaha, who also used crushing times for his benefit. This man used one simple principle: value investing. This method, which he learned from his mentor, Benjamin Graham, involves buying stocks that are undervalued compared to their intrinsic worth and holding them for the long term. Buffett's approach is simple but powerful. He doesn't try to time the market. Instead, he focuses on acquiring businesses he believes are fundamentally strong and will grow over time. Buffett started his career in the 1950s by creating an investment partnership. Initially, he invested small sums of money from his family and friends. As the fund grew, he was able to make larger and more profitable investments. By 1969, his net worth had ballooned to $25 million, which was quite a lot at that time. In 1965, he took control of Berkshire Hathaway, a failing textile company. He used this company as a vehicle for his investments, eventually turning it into one of the most powerful conglomerates in the world. Under his leadership, Berkshire Hathaway invested in a variety of sectors, including insurance, energy, and consumer goods, with major stakes in companies like Coca-Cola, American Express, and Apple. Buffett's success isn't just from picking the right companies, but also from the way he thinks about investing. He encourages people to treat stocks like businesses, saying, if you buy a stock, you're buying a business, and if you wouldn't buy the business, then don't buy the stock. This mindset helped him navigate even the toughest market downturns. For instance, in 2008, during the global financial crisis, Buffett made a $5 billion bet on Goldman Sachs, securing an investment that would eventually bring him a $3 billion profit. His focus on long-term growth and disciplined investing has earned him a place as one of the world's richest individuals, with a current net worth of over $147 billion. Another business savvy is Elon Musk, who also used crunch time to his benefit. In 2008, during the global financial crisis, Elon Musk was facing a near-total collapse of both Tesla and SpaceX. The year was especially rough. Musk was personally bankrupt, and both companies were on the brink of failure. Tesla was struggling with production delays and cost overruns, while SpaceX had already suffered 3 failed rocket launches. Musk's situation was dire. He had invested his entire fortune from the sale of PayPal into these companies, leaving him with virtually no personal assets. To survive, Musk risked it all. He personally injected $40 million into Tesla and secured another $40 million loan, even though it seemed like a gamble. Tesla was just a few hours from missing a crucial funding deadline on Christmas Eve of 2008, which would have meant an inability to meet payroll. On top of that, SpaceX was barely hanging on, but Musk pushed through, and the company's 4th rocket launch in December 2008 succeeded, securing a major NASA contract worth $1.5 billion. Despite the setbacks, Musk's commitment paid off. By 2010, Tesla went public, raising $226 million in an IPO. This marked the beginning of a turnaround for both Tesla and SpaceX. Tesla's Model S became a breakthrough success, and in the years that followed, both companies soared in value. Today, Tesla is one of the most valuable companies in the world, and SpaceX has become a leader in space exploration. And by the way, Elon Musk's net worth has skyrocketed to $316 billion. When COVID-19 pandemic hit, it proved to be a catalyst for a significant boom in tech companies and individual investors, particularly in sectors that were well positioned to thrive in a digital-first world. With lockdowns and remote work becoming the norm, tech stocks surged. Companies like Amazon, Microsoft, and Zoom saw their valuations skyrocket, with Zoom's stock growing by 275% in 2020 as remote meetings became essential. Investors also capitalized on the market shifts. The pandemic accelerated the trend of younger, tech-savvy investors flocking to the stock market, driven by the ease of mobile trading apps and commission-free platforms like Robinhood. Many people turned to growth stocks and innovative tech sectors, betting on companies that would benefit from the pandemic's long-term effects, such as e-commerce, digital communication tools, and cloud computing. A key factor in this boom was the rapid digital transformation across industries. Businesses scrambled to implement technologies that allowed employees to work from home, pushing up demand for cloud services and cybersecurity. For instance, Shopify, which provides e-commerce tools, saw its stock to surge over 400% during the pandemic. Key strategies for spotting opportunities in a downturn. Spotting opportunities in a downturn requires a shift in mindset and strategy. One of the first steps is to stay informed. Keep up with market trends, news, and shifts in consumer behavior. Our phones are excellent sources of news and trends, and you can keep an eye on the financial markets by reading the news, watching podcasts, and following people who talk business. They know the ins and outs of the financial world and can give you an idea of when to invest and when to make a profit. Some good podcasts to listen to for financial advice are The Ramsey Show and the Clark Howard Podcast. Economic downturns often expose weaknesses in certain sectors, but also create openings in others. For example, during a recession, tech, healthcare, and e-commerce companies often thrive as businesses and consumers adapt to new needs. You should look for industries that are essential or have found ways to innovate during tough times. Next, look for assets that are undervalued. In downturns, many companies' stocks can drop below their intrinsic value, offering opportunities for long-term gains. This is where research comes in. Look at the fundamentals of a business. Are they strong enough to weather the storm? Companies with a solid balance sheet and strong cash flow, even in hard times, can be ripe for investment. Think of it like buying a good product at a discounted price. Many successful investors, like Warren Buffett, have made fortunes by buying when others are selling out of fear. And lastly, be patient and disciplined. Don't expect quick results because no one becomes a millionaire overnight. In times of crisis, it's easy to be tempted by short-term rewards, but focusing on long-term value is key. The downturn might last longer than expected, and businesses may need time to rebound. Stay calm, stick to your plan, and look for opportunities that align with your long-term goals. How to pinpoint opportunities to make wealth in today's world. In today's financial landscape, pinpointing opportunities requires focusing on emerging trends and sectors that are poised for long-term growth. First, tech innovation remains a key area. With artificial intelligence, cloud computing, and cybersecurity advancing, investing in companies like Nvidia, Amazon, or cloud service providers could be profitable. These industries are experiencing massive growth as businesses and governments push toward digital transformation. From the investment side, focusing on sectors with strong growth potential is key. A major area to consider is technology, particularly AI. The global AI market is expected to reach $1.8 trillion by 2030, driven by advancements in automation and machine learning. Companies like Nvidia, which designs graphics processing units or GPUs, which are critical for AI applications, have seen their stock price surge, with their market cap surpassing $3.5 trillion this year. Another area is renewable energy. As the world moves toward sustainability, companies in solar, wind, and battery storage, like NextEra Energy, the world's largest wind and solar power producer, are well positioned to benefit from this boom. Their stock has grown by over 50% in the past 5 years. The push for green energy is accelerating globally, and governments are offering incentives that boost these markets. The renewable energy market is expected to reach $1.98 trillion by 2025. For those interested in real estate, logistics properties are a strong bet. E-commerce is booming, and since businesses need space to keep their inventory somewhere, warehouse and distribution center properties are in high demand. If you have enough money to invest, go for it, as warehousing will always be in demand. And then there is cryptocurrency. Although they are volatile, much like the stock market, the rise of blockchain technology is undeniable. The rise of Bitcoin is a commendable one. It began back in 2009 through the anonymous creator Satoshi Nakamoto, which started as an experiment in decentralized currency, but eventually grew into a global financial phenomenon. In its early days, Bitcoin was worth practically nothing. Can you imagine that people even paid 10,000 BTC for 2 pizzas in 2010? But guess how much that is today? $880 million. Crazy, I know. Bitcoin's initial adoption was slow, and people were skeptical of digital currency's legitimacy and stability, especially because there was no central authority backing it. Yet, a dedicated community of developers and early adopters began advocating its advantages, including transparency, security, and freedom from traditional banking fees. By 2017, during a global crypto boom, Bitcoin soared past $19,000 and then experienced a sharp drop because of volatility. But with growing institutional interest, such as big companies and investment firms adding Bitcoin to their portfolios, it became mainstream. This renewed interest pushed Bitcoin to a record-breaking high of almost $90,000 recently. Imagine someone who bought a few Bitcoins for no reason back then. They must be enjoying their immense profits now. Bitcoin's rise underscores a shift in financial thinking. It has evolved from a niche experiment into an accepted asset class. Supporters see it as a hedge against inflation, especially in a time of financial instability, as Bitcoin's limited supply of 21 million could make it a safeguard against currency devaluation. That's why Bitcoin continues to show great performance and is making tons of money for its owners. So what does the future hold? Are we safe, or is there a financial crisis coming up? Financial experts are split on the likelihood of a recession in 2024. While the US economy showed unexpected resilience in the last year and continued through 2024 with steady GDP growth and low unemployment, factors like high interest rates and ongoing inflation worries have many analysts still predicting a potential downturn. Then again, USA is still on a solid footing in the fourth quarter of 2024. So many economists, including the Federal Open Market Committee (FOMC) members, anticipate a soft landing for the US economy. There has been a drop in the unemployment rate from 4.2% to 4.1%, and this has reduced the fear of an economic downturn. So even if the chances of a financial disaster seem low, we should be able to pull through any crunch without having to lose all of our values. There are some proactive steps that you can take to be financially prepared. Building an emergency fund is essential, and ideally, you should be covering 3 to 6 months of living expenses because they will help you stay afloat if job opportunities shrink. Diversifying investments is another key move, and this way you aren't putting all of your eggs in one basket. One straightforward approach is to lower your exposure to high-risk stocks and maintain more cash. Although cash may seem like a conservative choice, it adds stability and gives you flexibility. It's always readily available, so you can quickly jump in to seize the right investment opportunity. Right now, 1-year certificates of deposit offer interest rates of up to 5%, allowing you to secure a stable yield before potential rate cuts. Some sectors generally perform better than others during economic slowdowns. Utilities, healthcare, and consumer staples are known as defensive investments since they provide essential services and products that people rely on regardless of the economy. For instance, companies like Walmart, Abbott Laboratories, and Synopsys have managed to outperform the S&P 500 index during past downturns, including those in 2008 and 2020. This makes them attractive options for risk-averse investors. If you are looking for long-term goals, which ideally everybody should be, then sticking to your investment strategy and riding out a recession can also pay off. This means that even if everything's on fire, you stay put and stay the course of it. Some experts believe that as some investors who were overly cautious earlier in the year start investing again, we could see market prices increase further. This means that there is potential in the current market because of the rise in AI advancements. The prediction is that this AI-driven momentum will last several years, possibly pushing the S&P 500 to surpass 6,000 by the end of 2024. Key takeaways for building wealth during a financial crisis. So what have we learned looking at the people who have done well in the worst of times? Diversify investments. Spread your investments across different assets and sectors to protect against volatility and reduce your risk. Prepare financially. Build an emergency fund covering 3 to 6 months of your expenses, and always maintain some cash reserves to seize golden opportunities. Invest in essential sectors. Sectors like healthcare, utilities, and consumer staples tend to perform well during downturns because these are the essentials needed at all times. Focus on value investing. Look for assets that are undervalued but have strong fundamentals. Buy when others are fearful, because the strong companies can rise from the ashes. Embrace emerging trends. Industries like tech, renewable energy, and logistics offer promising growth. Companies like Tesla, Amazon, and AI-driven firms have shown resilience and profitability during recent crises. Cryptocurrency is also a good place to invest for the long-term benefit. Stay informed and educated. Regularly follow market trends and stick to a long-term investment plan. Follow credible financial news, podcasts, and expert insights to stay on top on the economic shifts. Be patient. Remember to be patient and don't give in to impulsive decisions. Play the long game and always reinvest your profits for even better returns. Looking at all the history of people reading the market and grabbing the unlikely investment options has really paid off. And if you keep your research game on point, then you can also earn some hefty profits down the line. So what are your plans? Are you prepared to counter and ride through if a financial crisis does occur? Tell us down in the comment section. Press the like button if you liked the video and subscribe for more interesting ones. Thanks for watching, and I'll see you in another one soon.